question I received recently, and we hear this all the time, is, hey, I've got some debt, Steve. Should I pay off the debt before I consider opening a policy? And the answer is, it depends. Which I hate that answer, by the way, but it really does depend in this case. You know, a lot of times you'll hear of the idea or concept of a velocity banking. How do I quickly pay off that debt? And that concept works beautifully. But how do I use it in conjunction with a high cash value life insurance policy or infinite banking perhaps? Well, it is true that once you pay $1 through a cash value life insurance policy, regardless if you let it sit and grow or if you borrow against it, you continue to yield that compounding. There's no lost opportunity cost. So when it comes to paying off debt, a lot of people are attracted to the idea of paying money into a policy, then borrowing it out, and paying off the debt, and then repaying that policy loan. Can it work? Absolutely. However, what are the drawbacks? We always see that plan, that idea marketed and pushed heavily because it's attractive, to be frank, but what are the drawbacks? We always like to look at that, even with the cash value asset in itself. So the number one drawback to using a whole life insurance policy to pay off debt immediately is when you first pay $1 into a policy, no matter how well it is designed, that policy that is, we have a negative hit right off the bat. When I borrow from a life insurance policy, there is loan interest. So I want to be aware of what's the first year cash value, how big is the hit, because there's going to be a negative return, and then what is the interest cost associated with that. Depending on the policy, it might be between 5 and 6%. And then factor that in with the debt I'm paying off. Is it high interest credit card debt? Is it a line of credit or a mortgage? What is it? Student loans? What is it that I'm trying to pay off? And then spreadsheet it out, measure it. Okay, here's what it looks like if I pay off the debt first and then fund the policy. And then here's what it looks like if I fund the policy and then use the policy to pay off the debt and then repay the loans. A lot going on there, I know. But that is something we like to model out and see in every case, as opposed to just say, option A is the best way to go, do that, because we see that quite a bit. But the strategy certainly can work. But like any financial strategy, we want to see it. You know, people are going to trust more what they see as opposed to what they hear. So we want to make sure that anyone we work with sees the strategy or concepts that we are discussing. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.